All right. Hey, Paul.
Hey, Fab.
That was a little weird. Weird technical
Yeah,
issue at the intro. The video didn't play. The sound played. So
the sound
considering
played.
most people
I
listen,
didn't hear. I didn't hear the sound or the video. But anyways, you're here.
oh,
You're back, so that's good.
that's good. All right, Paul. How's it going?
I'm doing well. You?
Good, good.
Good.
Today we have an interesting conversation. I don't have much structure around it. It's just something that I've been noticing. The more clients I work with, the more I realize like a lot of people do struggle with forecasting, and it's an important thing, right? Because you have your goals and your targets at the beginning of the year, and obviously there's corresponding budget to that. How much you can spend on software, how much you can spend on staff, and everything. And so forecasting, kind of showing where you're at versus that goal, and when are you on target, not on target, and stuff like that is obviously crucial for any business. Maybe a little less, early stage when you're just trying to get opportunities in the pipeline, and you may not have any very fixed goal other than just like, let's just get stuff in the books. But forecasting becomes a thing relatively quickly, right? You need to be able to predict as much as possible what's going to be coming in. So like I said, I don't really have a structured conversation around this. I think it's just a topic that's interesting. So I kind of aptly named it Plan and Run a Forecasting Meeting. So Paul, how do we plan and run a forecasting meeting?
Well, okay. So I promise to get into that, but I've got a question for you first.
Yes.
And I got a question and a comment, but I'll ask my question first. So
Awesome.
You sort of said it earlier. So we forecast to figure out the goals and targets, but so why do we forecast other than that?
To me, is a big barometer. It's a big barometer in terms of like where we're pacing in terms of that goal, right? If I'm a rep, and let's just pick one rep to make it easy, but I have one rep and their goal this year is to make $10 million, right? And I've set up different, based on cyclical, maybe in the summer is slower, but I've set up kind of the targets. I've broken down the target by month and stuff like that, and so my forecast kind of allows me to see how on pace we are, right? Because if my target is 10 million and we're September and I'm realizing they're at 3, there's clearly a problem, and that's what so it's kind of helping us not predict but follow our sales results, and predict our sales results, right? Because you can do weighted forecasting to see what's been signed, but also what's predicting to close by the end of the period.
Yeah. So
that was a long-winded answer.
Yeah, and it's a good answer. So obviously we need forecasts when we're running a business to sort of to figure out what it is that we're going to do, like how the numbers are looking in the future to sort of predict the closing of future business. Now, forecasting is a prediction, right? So, and predictions are not precise, because you spoke about precision. They're not precise, particularly when economic factors or outside factors affect what you're doing. So anyone who tried to predict, anyone who predicted their growth last year is probably, biting their fingers this year. If, let's say, they're in the financial markets and they were predicting the growth value of certain stocks, well, they might be in the toilet, because it's hard to make a prediction, right? But what you need to do when you're making a prediction is, there's two things that I think really work well to make a prediction. And I'm speaking from experience here. The larger the amount of data you have, and the more that the outside factors are the same. So if you have a team of 100 people, and you're looking at year over year, last year, and you're looking at where they finished April last year and where they finished April this year, and where they finished the first quarter of the calendar year this year as opposed to last year, the larger the amount of numbers you have, and the more that the economic factors and that your market is the same, the easier it is to predict, right? Because then you're assuming, and this, I'm going to come back to this later, you're assuming that they're doing the same activities they did last year, right? The same amount of cold calls, the same amount of clients, All that is an assumption. So quickly, snapshot, you're looking at the first quarter of last year, first quarter of this year, all economic factors being the same. You're looking at where your months are going now, and you can get a good feeling of where you're going to end. So in a past life, I did this. It worked extremely well. I was in a mature industry with irregular growth. I would even look at year over year over a couple of years to see what the trend was. And I would usually fall within about 1 or 2% of my prediction because everything else was the same. You know, I had the same reps. I had the same group of people. I had the same managers. So I knew pretty well where things were going, you know, unless something big changed, then the prediction was there. Now, so when you're running a forecasting meeting, let's be honest, mostly the forecasting meeting helps management. It helps upper management. So often the reps or the lower, I don't want to say the lower, the people who are on the streets, not lower, but the people that are on the street are asking to be making a forecast. They know that in their world, it doesn't make a big difference because if they don't hit that magic number, they're not going to get the commission. If they hit the magic number, they're going to hit the commission. So it's like, well, why should I be forecasting? I should be working on my work instead. Because, you know, when I'm spending 3 hours to develop a forecast for my manager who's going to give it to my VP, who's going to give it to my chief revenue officer, who's going to have a conversation with the CEO just to make the shareholders happy, it's kind of frustrating. You're like, I'm spending 2 hours a week creating these bloody forecasts. Meanwhile, I'm not out selling, right? So first point. So if you're having an intelligent forecasting meeting, there has to be a benefit to the person who's sitting in front of you, right? So, and the more micro you get, the more market conditions can affect your forecast, right? So let's say you're talking about a mature industry and you lose a big account in a network and it goes to another part of the country. Well, that micro person's forecast goes down a lot. Like, let's say they used to sell $10 million of advertising last year, and GM moved from Montreal cassette to Toronto cassette, and now there's a Toronto rep. Well, your numbers went down by 5 million, and their numbers went up by 5 million. Overall, the company is still making 5 million, but the individual's forecast in Montreal dipped down by 5 million.
Right.
So the more micro you get, the more of those numbers games becomes a little bit more difficult. As an individual, when you're making a forecast, I think what you need to do is look at your funnel, where your funnel was last year, what did you have in there, and know your closing ratio, right? So if you're a really good rep and you're a new business development rep, and you know that when I have $100 million in my funnel, of course it's all weighted, but let's say my $100 million means $1 million of sales. Well, you have that 100 million in there. You can predict or forecast, with your sales cycle that in the next month it's going to be $5 million of sales because your sales cycle is always 2 months. Then you're getting good at forecasting. So what you need to do to run a good forecasting meeting is also to eliminate the bullshit. You say, hey, listen, I don't want bullshit forecasts. I want to know the truth from you to tell me what you really expect to hit based on the data that you've collected and based on the activities, because that's the only two things you have, right? You have your data and you have the activities. So you know what activities you're doing, you know what's coming in, you know how it's going down, but you also know what you did last year and what your closing ratio is. So how do you run a good forecasting meeting? You make it so there's an advantage to the person who you're asking to give you the forecast, right? So if I'm asking a rep, what are the activities you're doing? I'm also helping him achieve his own goals and objectives, either commission, bonus, whatever it might be, promotion. But so what I would say is, if you're a manager that's asking reps to run a forecasting meeting, you're looking at data, yes, past year's data, current numbers data, but you're really looking at activities. And you're also looking at the person's numbers, their batting average. So if you know their batting average, if you know their activities, and you know what's in the pipe, you could probably come up with a pretty good forecast. Now, all formulas are different. All companies are different. How do you run a good forecasting meeting? You make sure that you as a manager are getting the buy-in for your reps, because they see the upside, not just for the upper management, but for themselves, right? And that to me is the state of mind of running a proper forecast. The technical way of running a good forecast is really to make sure you're going after those three pillars.
Right. And can you remind me the pillars again?
Well, your activities, right?
Like the sales activities, like the calls.
Your sales activities. What's in your funnel and how you weight it through your closing ratio. So closing ratio is one, what's in the pipe and your activities.
Gotcha. And so you mentioned something about it taking, a few hours a week or a month or whatever, depending on how often you need to submit forecasts. But shouldn't your CRM kind of help you do that, right? Like, because if your stages are well balanced, and if you're monitoring your conversion rates per stage on a regular basis, monthly, quarterly, whatever makes sense for your sales process, like, shouldn't it be relatively easy to be like, okay, well, I have, 5 million in stage 3. We know the conversion rate is, 50%, just to make it easy. So there's, I can predict that I'll bake, 2.5 million, right, within 3 months, because that's our sales cycle from that stage on, and takes 3 months type of thing.
Yeah. So ideally, if you're running it properly and you're using your CRM properly, really be, hey, Fab, so I'm looking at your numbers, and from what I've seen in the past, this over the next month, you should be booking this amount of money. Over the next 6 months, it should look at this. Is this a fair assessment? Yes. So is there anything that would make it different? Well, actually, I've got this big account in the pipe that just sold yesterday that hasn't been reflected in numbers yet, and that's going to change it. Okay. So that's the kind of thing you want. You want the human input to tell you about the things that are not in the data.
Right. Or for example, there's something in that stage, but that person had to go on sick leave for a month. So then obviously, while normally your sales cycle is 1 month, that it's not going to happen in a month because they're not going to be back right away, and so on. So so your CRM is kind of like your benchmark, but then there's like the audibles on the field, right? Like what's going on the field. So then it's safe to assume that. And do you run your forecast, like, do you, not the presentation of the forecast to the higher ups, that's maybe another conversation, but when you're working with your reps, are you working individually, kind of going with them, like, what's in your pipeline now, is this accurate, or are you just kind of like sitting back and waiting for the numbers to pour in?
Yeah, I mean, some people do that. Sure, if you can afford the time and you do one-on-one, it's great. But most forecast meetings I've been in, it's a bunch of people sitting in a room and going one after the other, talking about why they're not going to hit their numbers.
So that's interesting, because
making excuses on why they're not going to hit their numbers.
So that's interesting. So that kind of like takes away a bit what we were just talking about, which is the CRM component, right? Like, shouldn't it be pretty obvious? I mean, if that's how your forecasting meetings happen, isn't there? I mean, it's clearly a sign that something's off, right? That the process isn't right.
You and I both know, you and I would both have a lot less work if people use their CRM properly. So a lot of unfortunately, a lot of companies don't use the CRM properly, and they're sort of half-baked, or 25% or 15%.
Right.
If someone's using the CRM properly, the managers barely have to speak to the reps. They can create a forecast in and of themselves, and they could just ask the question, is there anything in the numbers that we see that we should be leery of or wary of, or that's not in the numbers yet that could affect the forecast?
Gotcha.
Yeah, because upper management wants forecasts. You said it, to decide how much they're going to spend, to make a report to the shareholders. Let's say they've had a really bad quarter and the forecast looks like things are moving up. Well, the CEO wants to make sure that there's investment, so they're going to talk about that coming up. So there's all kinds of political massaging going on with the numbers that you're giving, the public company. But ultimately, to me, if we're staying in the sales world as a VP sales, your forecasting should really be to figure out what you need to do to help the company move forward, right?
Can you explain that a bit more?
Well, if you're forecasting for shareholders, why you're forecasting. You're trying to get your stock value up, right? Yeah. If it's a private company and you're forecasting because you want to make a big investment, or you want to move into a new country, or whatever it is, and you have a really long sales cycle, so you got a 2-year sales cycle, you need to know what's in the pipe now. well, forecasting becomes very important. If you got a 1 week sales cycle, forecast is useless.
Of course, right.
I mean, you don't really need it. It's there. You know what's coming. So then it's just a forecast of activities, and you know what drives those activities. Well, then you're okay. So I in all forecasting meetings I've had, you know who the sandbaggers are, you know, the super enthusiasts. And yes, they'll look at the numbers and they'll look at the CRM, but a lot of them will also massage what's going on. Excuse me, I'm going to sneeze, maybe. Maybe not.
Cool. And so I have another question for you. And going back to your 3 pillars, because there's 2 things that you said that were really, well, you said a lot of interesting things, but 2 things that stood out to me was those 3 pillars and kind of why you're doing this. I'd like to go back on the pillar side 2 seconds. Just obviously, like, I have an operational background, and that's maybe what interests me. But how should you be using those 3 pillars? So again, if you can remind us, in case people are skipping forward, like what those 3 pillars are, and then how can you be building those into your CRM to help that
forecasting? I think some of those pillars are naturally built in the CRM. So if you have a good CRM, you're tracking activity, right? And what do I mean by that? Emails, calls, follow-ups, all that, okay? That definitely can affect your forecast, because if you have a long sales cycle and you're not doing your calls and emails and follow-ups, well, that's going to eventually trend downwards, right? The second
so can I just stop you there 2 seconds? And then, so then basically what you're saying, there's a forecasting meetings where we're going to look at the numbers, but part of that forecasting meeting is also looking at the activity, right? To make sure that activity, the sales activity, is staying, constant or upward and not.
I think that down. Sales activity number you're always talking about that. You're talking about that in your one-on-ones, because that sales activity also helps the sales rep a lot, right? Yeah. If for whatever reason they're not doing the proper sales activity, well, it affects the current value, but it also affects your forecast, particularly if you have a long sales cycle. So that there in and of itself is important at all levels. Should that be part of your forecasting meeting? It should be. It's just there, and it affects forecasting eventually.
Fair. All right. Pillar 1, activity. Let's keep track of it. I think just because it is so one of your pillars, I think I would argue that it's worth looking at and monitoring during your forecasting meetings.
Yeah.
Pillar 2.
So pillar 2 is what's in the funnel.
What's in your funnel? So at each stage of your sales pipeline or whatever.
So your total funnel value. So let's say there's $100 million in your funnel, and you know that $100 million usually in the past years and the past months converts into $1 million, right, of sales. And you need to know the ratio. So, and pillar 2 and 3 are kind of tied together. Is that okay? If that's your regular ratio and you're doing all the activities you need to be doing, then that's fine. So then you need to be looking at what's happening at your closing ratio. Because the closing ratio you can know now something that's only going to affect your CRM a little bit later. Right. So if you know something now, there's a new competitor that just came into the market right now, and there's a few sales I'm losing. Well, my closing ratio might go down. Right. And it might not be reflected yet in the CRM. So that's your pillar 3. But pillar 2 and 3 are they're separated, but they're together. It's to be cognizant of what could affect your closing ratio, and also to be cognizant of what's happened in the past in your closing ratio. And it might be the other way around. There's a big competitor that just shut down, right? They just announced it last week. So now instead of being 4 in the market, we're only 3. Well, boom, your closing ratio might go up. And it won't be reflected yet in your CRM or in your sales, because you might have a 2-year sales cycle. But eventually when you're forecasting, you say, hey, or maybe you just bought the competition. Yeah. So, hey, all of a sudden we're only 2 competitors. We used to be 4. Hell.
Yeah. And so then if I take down like pillars 2 and 3,
there's actually a 4th pillar that I didn't mention yet.
Okay, cool. It's pillars 2 and 3. So I guess it's fair to mention and maybe that's not part of the forecasting meeting itself, but maybe in the build-up too is kind of reviewing your closing ratio, then your conversion rates by stage, right?
Yes,
because you want to make sure that's staying constant.
It is part of the forecasting meeting, because that's very to-the-date information that might affect how your closing ratio will be affected.
Fair. Okay. What's your pillar 4?
4th pillar also affects 2 and 3. the only one that is your activities is independent. You know, we've often talked about it's the only thing you control, and that's actually the most important thing.
Yeah.
But when forecasting, you have to consider the market, the economy. We've talked about competition and the closing ratio. So, but the market, the economy, competition, that has to be considered, because when you're talking about forecasting, for example, if I'm in real estate right now and I'm forecasting, I'm probably going to forecast a little bit of a decrease in sales and maybe even a decrease in pricing. Right? But that's not me doing that. That's the inflation worldwide. That's a pandemic. So it doesn't affect what you're going to, your activities. You might do more activities, but it doesn't directly affect your activities, but it directly affects your closing ratio and hence eventually your funnel.
Right. So you said something.
It might not affect your closing ratio, but it might affect the size of your deals or the frequency.
Or the amount of your deals, right? So what I'm seeing is that your forecasting meeting, yes, is looking at the numbers and what is the rep forecasting to actually close, and that if your sales process is set up properly, should be relatively close to what's in the CRM, right? If we have $1 million, if the CRM is predicting $1 million in closing, like the rep shouldn't be too far off from that if you set it up properly. But then it also means looking at activity, because if you're looking at, last month we had a down in activity because Paul went on vacation or something, and that's not reflecting the number. Like the numbers need to reflect that, right? That there might be a certain, obviously your sales process is long, maybe a 2-week period of low activity won't affect that much, but then it's also looking at, and maybe that's preparing for the meeting, like looking at your conversion rates from stage to see, are they stable, are they not? Because if they're not, they could be an indication that something's going on that you're not aware of. And then what I'm seeing is maybe that third pillar is also leaving some space in that meeting, or maybe the kickoff to the meeting, of like industry trends and what's going on in our industry, competitors closing, competitors starting, interest rates going up and inflation going up, like anything that could potentially impact your business. And because I'm guessing at the end of the day, and that ties into the other element that I wanted to bring in that you mentioned was super interesting, which is like, why are you doing this? Fine, you have your shareholders and your C-suites and all that, and we know why they want those numbers, because they need to see what's happening with which direction the business is going in. But you're also doing it for your reps, because if you're forcing your rep to submit numbers, it's helping them make sure that they're on track with their objectives, whether their objectives are purely financial because they're much more money driven, or their objectives are much more personal, like they believe in what you're selling. And if they're realizing their numbers are down, like obviously you're not, you want to help them get to like achieve their goals. I'm wondering if part of the sales meeting is also ending with conclusions, right? Like, fine, we have our numbers, we agree that these are the numbers, but what's happening too? If we look at our forecast, if we look at the industry, if we look at our closing rates, like stuff is moving. How are we going to address that? Well, we're expecting an increase in activity, let's say next month or next quarter, because sales are going to be more difficult now. New competitors in the space, inflation's up, people have less budget, people are more nervous, they're not going to do their investments as much, and stuff like that. Does that make sense?
It makes a lot of sense, and you're saying something that is making me think of the reason a lot of forecasting is off. And I'll tie it into remuneration for a second. If as a salesperson, your remuneration is based on results, not activities, which most of them are, let's face it. It's not the best way to do it, but most of them are. Then when you're forecasting, right, you don't want to get fired. You might forecast higher because you're afraid you might lose your job. There's that kind of behavior, which is ridiculous. And then you're also getting the sandbaggers, because what you're expecting of people, what you say is, I'm going to forecast a lot less and I'm going to blow it out of the water, and then you're going to be happy with me. A lot of people have that approach because they figure, well, that'll protect them as well. If you really want an honest forecast, you have to dissociate it from any judgment. And that's what a lot of sales managers have a hard time doing. So it's almost when you walk into that sales forecasting meeting, you get to tell all your reps, listen, I'm not going to push you or judge you on any of this right now. This is not about accountability. This is about forecasting. And forecasting often is mixed at the lower level with accountability. So your rep comes in, gives you all, like I said earlier, excuses to bring down a forecast or to bring up a forecast for whatever reason to protect your ass from being bullied by your boss. But really, when you have a real forecasting meeting, it should just want to be able to predict with the activities that are done now, not judging anyone, where the numbers should end up. And if you do that kind of meeting, you'll get much more honesty. Do the accountability later, do all that stuff later, or in another meeting based on activities, not on results. Because again, of those 4 pillars, you only control one. You control activity. You don't control, well, you do control what's in your funnel because you put them in there with the activities. But then again, if there's really bad market conditions, you might have to do twice as many activities to get the same amount in your funnel, right? And then your closing ratio, well, that's affected by the economy, by a whole bunch of stuff. And then the economy itself, you're not affecting the economy unless you're the president of a country. So really, when you're keeping people accountable, you should be keeping them accountable on activities. But if they're forecasting and those 3 other pillars are just like nasty, or there's 2 other pillars that affect the 3rd one, then you shouldn't be using your forecasting meeting, because if your rep's doing everything they should be, and they're starting to give you false numbers in forecasting because they're afraid to get beat up. So just remember that when you're forecasting, just look at the data. It's not a coaching opportunity. It's not a training opportunity. It's not an accountability meeting. Separate that. You're just looking at forecasting. And I've rarely seen that in my career, because even at the higher levels, it's like you're forecasting, hey, you're behind your other teammate there. Yeah, it's a forecast. You want me to tell you the honest truth, or you want me to lie to make myself look better? So forecasting, and then you can have another meeting to say, hey, look, you forecasted this. What can we change to increase those numbers or to put things on our side? And it's always going to drive back to activities. Always, it's the only thing you can do. Activities. Is it maybe more intelligent activities? More structured activity, whatever it is. It's, system, habits, actions. That's it. So I always get back into sales, but so forecasting, honest forecasting should just be based on data, market conditions. So the activities you do, what's in your funnel, how all that is affected in your closing ratio. We could even just boil down to 3. We could call it activities, funnel, including variety and closing ratio, and then economic activities.
Right.
Because the earlier 2 and 3, you could merge them together.
Right. Because it boils back down to being in the pipeline. Right. Paul, this was really interesting.
Can I make a quick summary?
Yes.
So we'll call it the 3 pillars, because the old 2 and 3 together. So the first pillar is your activities, right? So what's changed or what's going on with your activities? If for some reason your activities are going to go down, well, then that could affect your forecast. The second thing is your funnel, including that old number 3, which is really, we'll keep it number 2, which includes the changes in your closing ratio, so your funnel. Mm-hmm. And then number 3, economic, market, competitive information. Those 3 things together are the full universe of forecasting. There's nothing else. If there's a solar flare coming that's going to put down the whole electric grid, or a COVID, well, that's a market condition. That's a natural market condition. Nature affecting the market, right? If 5 new competitors come into the market, you don't control that. That's also a market condition. So there you go.
Yeah, and like what you said,
how to run the meeting, honesty.
Yeah.
Look at the
and I like what you said, like to take away judgment from that meeting. This meeting is about the numbers. You have 100 million in your pipeline. You're forecasting 99, 100 or whatever. That seems pretty on point. Next, Paul, you have, 1 million in your pipeline and you're forecasting 1.2 million, and so on and so forth. And it's just factual. And I think it's looking at, I like how, I don't know if it's part of the forecasting meeting per se, but I like the idea of like having the activity numbers in there, because it is factual, right? And we're making sure that the CRM is reporting them properly as well. And like, Paul, you've had like, 20 calls a day, your target's like 15 and blah, blah, blah. And you're just being factual. And I like leaving some time aside also for market conditions, right? Like, I mean, we're recording this in June 2022. I know there's a lot of activity going on, a lot of companies laying off, a lot of companies hiring. These are all trends that need to impact. Obviously, if you're letting go part of your sales team, that will impact your forecast at the end of the day. Even if deals are reassigned to reps, like the closing ratio might go down, right? Like a lot of the information, a lot of the steps might have to be redone and all that stuff. So I like the idea of leaving aside some time also to discuss economic or macroeconomic or microeconomic factors.
Yeah, you're right. It's macro and
well.
microeconomic factors. And what the reps will give you is micro, right?
Yeah.
They'll tell you, I mean, everyone knows that there's a pandemic, so that's, you don't need to tell me that, but you might tell me that, your biggest account that gives you 25% of your business is actually moving to Ontario because they don't like Bill 96. Well, you know what? That's micro, but we need to know that.
Yeah, or they're leaving. That's it, and then you might not be able to retain them because you don't have a presence in Ontario or the States.
Yeah, exactly. Or exactly, you don't. So they're going to be going to your competitor's business in Ontario because you can't retain them here. So,
that's important.
Yeah.
Okay. This is awesome. Paul, this is one of my favorite episodes in a long time. So thank you very much.
I'm very happy that you're happy. What are you saying? The last ones weren't good?
They're all good, but this one is really interesting.
Okay, all right. That's because you're on your own forecasting.
All right.
Bad. I caught you.
You did. Personal motivation, right?
Hey, I gotta say, I'm a cobbler's son. I personally don't look that much at economic factors because I run my own business and I'm solo for now. And I just focus on activities. I don't want because I don't want to get complacent or stressed out. So I just do the activities I need to do. And I don't have shareholders. Well, my wife's a shareholder, but I don't have, I don't have external shareholders. I don't have any, huge loans. So I don't have to justify to a third party what's going on. Right? They can justify to their third party. So it's interesting, right. But I would say to anyone who's got a small business, you can try to forecast. If you're going to the bank and they want to know what you're going to do and you're trying to do a big loan, you're trying to build a, of course you have to forecast. But if you're just like a service industry like we are, unless you're planning some huge investment, focus on activities. And then you'll know after a few years, these actually give me that much number. But that's a whole different discussion. Anyways.
Yeah, I mean, that could be debatable because, at the same time, while you might not be planning stuff, you still want to, if your goal is to, if your goal is not to scale, right? If you're happy at whatever revenue you're making and as long as that maintains, that's fine. But I think as soon as you get into a scaling mindset where it's like, how do I grow? Obviously, scaling usually involves more costs, right? More software, employees, whatever the case may be. Then you need to start being more attentive as like, how much revenue is coming in? How much am I predicting? Am I on track or not on track, and so on and so forth.
Yeah. I agree. I agree with that. I'm just saying, what is the purpose of your forecasting? When you're a solopreneur, the purpose of your forecasting needs to be a lot more precise, other than just you're a psychotic person who needs, a neurotic person who just needs to know every day where you think you might end up, right? So it shouldn't be based on neurosis, but real practicality that's going to help you move forward.
Awesome, Paul. Have a good day. See you next week.
Ciao.
Bye-bye.